All right. Hello, everyone. Welcome to my Secure Act 2.0 workshop. Go ahead and share my screen. And we will get started. My name is Cyril White. I'm a certified financial planner with FOR Financial Management. And I like doing these workshops and webinars and seminars because at my heart, I am a coach and I love educating people about important things. And being a certified financial planner, one of the latest important things is how the Secure Act legislation affects your retirement plan and your estate plan. So that's what we're going to talk about today. If you have any questions, if there's anything else I can do for you, please shoot me an email. I'll give you my contact information at the end of this presentation, and just shoot me an email, give me a call, and I'll help you any way that I can. So our agenda for today's presentation is, first, I'm going to give you my background, where I come from, what I've done, who I am, and my firm, FOR Financial Management, and our background. Then we're going to talk about the differences between traditional and Roth IRAs and 401ks. IRA stands for individual retirement accounts. Many of you, I'm sure, know what those differences are. You hear about them all the time. However, having done these a lot, I know that some people don't know what the differences are, and that's okay, because we're going to cover them. The Secure Act deals with a lot of retirement plan account issues, and they talk about traditional Roth, 401k, these throughout the act, and they're affected. So it's important to understand what the differences between those two types of retirement accounts are. Then we'll get into 4 key areas specifically of the Secure Act. The Secure Act has over 100 provisions dealing with retirement accounts, both for individuals and retirement plans or businesses. And don't worry, we're not going to cover all those, but we will go over some of the keys, which we've researched and come up with what the most important things we feel are going to be impactful from the Act for our clients. And we've narrowed those down so you don't have to go through 100 different provisions. What the Secure Act has been able to do, thankfully, is give people more time to save for retirement, more ways to save for retirement, new ways to save your money and to use your money, and something called the death of the stretch IRA. So 3 out of 4 of those are probably very positive things for people and their retirements, and number 4, not so much. So we weren't going to get 4 out of 4 from the government. So I think we should be happy with getting 3 out of 4 positive things from this legislation. A little bit about myself. Again, my name's Cyril White. I've been doing this for over 25 years. I've been a wealth manager, financial consultant, financial planner, call it what you will. I have helped people save their money and accomplish their financial goals over all these years. So that's what I do, and I continue to do so, and I love doing so. I started out in engineering as a computer science, computer software engineer. That's what I thought I wanted to do, but quickly learned that that's not what I was cut out to do. And because I was interested in how business worked, how the stock market worked, how the financial markets worked, so I went off and got my master's in business and finance from the University of Chicago, because back then, I'm so old, there was no internet, and you couldn't just learn anything on the internet. You had to go to where they knew about this stuff, and where they knew about this stuff, especially finance, was the University of Chicago. So that's where I went to learn my craft, then went, like many of the people who go to school there do, went to work for a large Wall Street investment bank called Merrill Lynch, and learned everything I could from them. And when I felt that I had learned everything that I could from them, I struck out on my own and founded White House Financial Services in 2001, just a couple months after September 11th. People thought I was crazy starting a business at that time, but it turned out kind of well because I ran that firm for over 13 years, became a certified financial planner in 2005, and a chartered sustainable impact investing counselor. It's a mouthful to say. Just last year, received that designation because one of the things that I love about this business is that you're constantly needing to learn new things to stay abreast of all the latest and greatest technology, tax laws, legislation, new investment products. There's always something to learn. I'm someone that gets bored very easily, but I've never been bored in this business, and there's always something to learn. So I continue to do that. In 2014, I realized I wasn't getting any younger. None of our 3 daughters wanted to inherit the business from me. I had a great staff, but there was only one of me. And I was tired of doing everything myself and wanted some continuity and a succession plan for my business and a bigger team so I wouldn't have to do everything myself. I love working with clients, doing these webinars and workshops, helping clients, being the client face, but there's just too much to do and I couldn't do it all myself optimally. My firm had grown so large, so I had to figure out something. I had to find a partner, and the way I did that was hire a firm that would go out and basically sell my business to other financial services firms. I had over 63 offers to merge with my business, and I interviewed all of them and came down with one that I thought would be a great fit for myself and my clients and the future of my business, which was For Financial Management here in Ann Arbor, Michigan, which was founded in 2008 by 4 partners who are all still with the business, all a very significant experience in the industry. And we merged in 2014, and we've been merged ever since, and it's been great. And what we do is we provide everything any large financial investment house can provide clients and more with a small firm. We have 10 seasoned industry professionals in our firm. So we're not a large firm, but we're large enough to provide excellent client service and anything clients needs and more to accomplish their comprehensive financial goals. We're a full service firm. We provide comprehensive financial consulting, planning, investment management, tax planning strategies. We do not provide tax advice, at least I do not. We do have CPAs on staff that do our clients and file our clients' taxes. We do estate planning strategies, working with estate planning attorneys for our clients, and risk mitigation and management through insurance. And if you email me at the end of this presentation or whenever, I will email you a Secure Act 2.0 highlights. It's a beautiful piece in a PDF, all nice and clear, and it's going to cover everything I'm covering in this presentation. So you don't have to take a ton of notes. Obviously, you could rewind the presentation since this is video as many times as you want. But if you email me or contact me, I will email you one of these highlights so that you'll also have that in the highlights of what I'm going to cover during our presentation today. So the Secure Act is a piece of legislation, or actually several pieces of legislation, and it's an acronym because our government loves acronyms, and it stands for Setting Every Community Up for Retirement Enhancement. Isn't that an awesome, clever acronym? Secure Act 1.0 was passed into law on December 20th, 2019. It was part of the Further Consolidation Appropriations Act of 2020. Secure Act 2.0 was part of a spending bill that was released on December 19th of 2022 and was signed into law by President Biden on December 29th of 2022. So these are very recent laws that have been enacted. They have over 100 provisions that affect both individuals and businesses. So there's a lot to these, and they take effect over a long period of time right now. So from last year through 2028, these laws are taking effect. So it's very incumbent on clients and you to understand if any of these affect you and your retirement and your financial plan, to know whether you need to take action or not, and modify or adjust your plan accordingly. As I mentioned, the challenge is it's a big law. It has over 100 provisions affecting individuals and businesses. It's the most sweeping, expansive change to retirement rules in 40 years. Excuse me. As I already mentioned, it affects individuals and businesses, and the rule changes provide more ways for us to be better savers, and is urging businesses to make it easier to do so as well. But again, planning is key, and it's important to maximize the new rules so we can maximize your retirement. But again, everyone's situation is different, especially everyone's tax situation. I am not a CPA. I do not prepare taxes, but our firm does. And if you have your own CPA or your own tax advisor, please make sure you consult with them on any of the things I'm going to cover in this presentation today, so that you can get the best advice that pertains specifically to your situation. Because I might mention something that you think is going to affect you, but it might not apply actually to your specific situation. So you want to talk to your own tax advisor. All right, let's talk about the differences between IRAs and Roth, traditional IRAs and 401ks, and Roth IRAs and 401ks. Many of you probably know the differences, so if you do, please fast forward this, but I'm going to go through it anyway because many people actually don't. I just talked to a client, a new client who came to us from another firm, and he had like 3 IRAs, a 401k that was inherited, Roth IRAs, and had no clue what he actually had. So it's important to understand this. And a traditional IRA, the biggest difference is its contributions are in pre-tax dollars. So you get a tax break on your income. It reduces your income, so you pay less taxes for the amounts that you contribute into your IRA. Currently, the annual contribution limit to a traditional and a Roth, they're both the same. The contribution limits are the same, is $7,000 unless you're over age 50, in which case it is $8,000. And in a traditional, so you've gotten a tax break on the money you've put in the year you put it in, but you're going to pay taxes on those dollars in the years you take them out. So tax break currently, taxes in the future. The other difference between a traditional and a Roth IRA or 401k is that you must also make a required minimum distribution, and we'll cover a lot more about these in this workshop because the Secure Act affects them significantly. You have to take money out of your IRA and your 401k starting at a specific age, and that's depending on the age that you're born, and we'll go into that momentarily. Roth IRA, which was created in 1998, and I am so old that I remember when the Roth IRA was created because I started in the business, as I mentioned, in 1997. So I remember this was a huge deal. All the investment firms, including my own, were very excited that this was something they were allowing people to do, and it created a lot of new activity and a lot of excitement in the investment world back in 1998. It was created by the now deceased Senator William Roth, hence the name Roth IRA. They created the Roth 401k in 2006, allowing a Roth component to be part of a 401k plan in 2006. And the main difference between traditional and Roth IRAs or 401ks is that the money you put into a Roth, you don't get a current tax deduction for it. But when you take the funds out, when you're retired after age 59 and a half, you don't pay any income tax on the funds you take out of your Roth IRA. And there are no required minimum distributions from a Roth IRA. So you can leave the money in there as long as you like up until you die. When you die, your beneficiaries have to get it, and we'll talk more about that and how that works later on in the presentation. But you could leave it in there. You live till 120, the money sits in there, hopefully growing, and you're not paying any tax on it. The first key of the Secure Act is that it gave us more time to save for retirement, specifically where required minimum distributions, which we talked about in the previous slide, are required. So the new law says that you don't have to, if you were born after 1951, you can start taking money out at age 73 as opposed to age 72 as the law currently stands. If you were born before 1951, you're already over 72, so you're already taking required minimum distributions, so that doesn't affect you. And if you're born between 1951 and 1959, you don't have to start taking them until you're age 73. And if you're born after 1960, you don't have to start taking your required minimum distributions from your IRAs, your traditional IRAs, because remember, Roth IRAs don't have a required minimum distribution until after age 75. The other thing that they did was that they reduced the penalties for missed withdrawals from 50% down to 25% with a 3-year look back. And if you correct the mistake in a timely fashion, within 2 years, the penalty's only 10% as opposed to 25%. And you would use Form 5329 to make that correction. And as we discussed, they eliminated, so while Roth IRAs, individual retirement accounts, did not have an RMD requirement, like traditional IRAs, in Roth 401ks, 403bs, and 457 plans, there was an RMD requirement. It was kind of like an oversight in the law, and they fixed that. I'm sure you're all familiar with 401ks, probably not so much with 403bs and 457b plans. Those are basically 401ks for nonprofit and government entities. Same thing, but in the nonprofit and government entity world. The Act also made new rules for surviving spousal beneficiaries. So effective this year, 2024, the surviving spouse can now adopt their deceased younger spouse's required minimum distribution schedule. So if you have an older spouse and a younger spouse, and the younger spouse predeceases, dies before the older spouse can take the younger spouse's required minimum distribution, which we spread out over a longer time because of the younger spouse's longer life expectancy, although even in this case, they died sooner, but that doesn't matter because they use a table for the life expectancy. And the older spouse could take that money using the younger spouse's RMD schedule versus their own, which if they had to use their own because they're older, they'd have to take the money out over a shorter period of time and pay more taxes on it. That doesn't mean that the older spouse can't take as much money as they want out of that, but they have to take that certain amount, the required minimum distribution. In addition, if the surviving spouse dies before the RMDs are initiated, their beneficiaries would be allowed to stretch the distributions over their lifetime, avoiding the new 10-year rule for disbursements. So younger spouse dies, older spouse inherits the younger spouse's IRA. They then don't start taking their RMDs yet because they're not old enough, and they die. Then their beneficiaries, who are usually the children, but don't have to be, would not have to take that money out over 10 years as the new law states. They could then use their own younger required minimum distribution tables so that they're not paying as much tax sooner. up until the Secure Act, when you turned 70 and a half, you could no longer contribute to your own IRA. They figured that most people 70 and a half would not be working anymore. But as we know, there are more and more people of all ages working these days. And if you have earned income, whether you're 70 and a half or 80 or 90 or 150, you can still contribute to your IRA if you have earned income, but your age will not matter. Earned income, not dividend income or passive income, but income from a job. The other big deal that the Secure Act did was they enhanced the catch-up contributions for qualified plans. Qualified plans are things like 401ks, 403bs, 457, business retirement plans. And effective this year, they made the catch-up contributions, which were typically $1,000 forever. If you're over age 50, you could contribute an extra $1,000 to your IRAs or your 401ks. They've now indexed those for inflation because, as we all know, we have great inflation right now. And those are going to be indexed every year after 2024 for inflation, so they'll increase. Also, catch-ups for employees making over $145,000 per year, your what are called high-income employees, have to be deposited into a Roth account. And if the employer does not offer a Roth, the employee will not be able to make the catch-up contribution. So if you're in this situation, you want to make sure your employer has a Roth option for your 401k. In 2025, they're going to make a special catch-up bracket for people age 60 to 63. Starting in 2025, if you're 60, 63 and you're a participant of a 401k or 403b, the catch-up for you contribution is increased to the greater of $10,000 or 150% of the regular catch-up contribution. So as I mentioned, prior to this year, the regular catch-up contribution has always been $1,000. That's now going to be indexed for inflation. And starting in 2025, the catch-up for people who are age 60 to 63 will be the greater of $10,000 or 150% of that regular inflation indexed catch-up contribution. And they've also added this option to simple plans. A simple plan is a small business retirement plan, similar to an IRA, but the employer can also make a contribution as well as the employee to a simple plan. And it's for companies that have fewer than 100 employees. They made a catch-up contribution for people between the ages of 60 and 63, the greater of $5,000 and 150% of the regular catch-up contribution. This slide shows you kind of graphically what we already discussed. Up to age 49 in 401ks and 403bs, there's no catch-up. Between ages 50 and 59, the catch-up is $8,000 currently in 2024, and that's being increased for inflation after this year. Between 60 and 63, the greater of $10,000 or 150% of the standard. And after age 64, it goes back to just the standard catch-up contribution, whatever it happens to be at that time. Key number 2 of the Secure Act is it gives you more ways to save for retirement. How does it do that? A lot of changes regarding Roth accounts, which we already discussed, in work-sponsored or employer-sponsored plans. The new law, starting last year, employers can make matching after contributions to the Roth part of a 401k plan, which prior to the Secure Act, they could only make the matching contribution to the traditional, and you had to transfer your contributions to your Roth if you wanted them to be in the Roth. In this year, as we already discussed, they're eliminating required minimum distribution 4 Roth accounts in employer-sponsored plans, and they're making a catch-up for high wage earners must go into a Roth account, which we've already discussed. Another change effective in 2025 is that there's auto enrollment. So employers are going to require that all their employees are auto enrolled if they offer in the 401k plan or 403b plans, and the employee will then have to opt out if they don't want to be a participant of that plan. So they're not forcing the employee to participate, but they're going to be enrolled automatically. And then if they don't want to participate, they can opt out. They think that this will significantly boost retirement savings for workers. And they've increased the amount that the employer can defer for the auto-enrolled employee. In year one, it's between 3 to 10% of the employee's income. And in year 2 and after, they can have a maximum deferral of up to 10 to 15%, but that will also be indexed for inflation by 1% every year. They're also allowing something called an annuity to be available in 401k plans. Prior to this, you could just have investments, mutual funds, exchange traded funds, things of that nature. And now they're allowing something called an annuity, which is a life insurance product, which guarantees a certain amount of lifetime income based on the amount that you're investing in the annuity. So you give a life insurance company a certain amount, and based on that amount and their actuarial tables and your life expectancy, they will promise to pay you a certain amount for the rest of your life. They're now making these available in 401k plans. They've also created something new called a starter 401k plan for small businesses. This is kind of like an IRA for small employees of small businesses, and doesn't have as many of the reporting requirements and administration of a traditional 401k plan. And this will also require employees to be auto-enrolled in this type of plan, and they'll be able to opt out if they don't want to be a part of it. They're also allowing part-time workers now to be able to participate in 401k plans. Before this, you had to be a full-time worker to be able to participate. And now you only have to work at least 500 hours for 3 consecutive years, or 1,000 hours throughout the year in any given year to be eligible to participate in your company's sponsored 401k plan. Excuse me. They've also made Roth IRA options, or not IRA because they're not individual retirement accounts, but Roth company-sponsored retirement plan options in SEP and Simple plans, which are retirement plans for smaller businesses. Primarily the difference, they have amounts, the amounts that you can contribute to these two. Simple plan, you have to have fewer than 100 employees, and SEP plan, only the employer can contribute, but Simple plans, the employer and the employee can contribute to the retirement plan. In last year, they made Roths available in SEP and Simple plans. And they've also added the ability to have a SEP IRA retirement plan for a household employee. They've also added additional employer contributions to Simple IRAs that are capped at $5,000 per participant. In addition, they've added this emergency savings component to retirement qualified plans, employer-sponsored plans, which says that an employee who is undergoing some type of emergency, which is defined by the government and administered by the 401k administrator as to whether it's truly an emergency or not, they can take out $1,000 in any given year. Highly compensated employees are not eligible for this, and they must repay the amount or wait 3 years to take another emergency amount. and they will not be penalized the 10% penalty that you typically are if you're under 59 and a half and you're taking money out of your qualified retirement plan. They've also instituted student loan help from employers so that if you are a participant in a 401k plan, 403b plan, 457 plan, or simple IRA, and your company makes matching contributions to your retirement plan. For example, the University of Michigan has they used to do 2-for-1 into the retirement plans of their employees. So if you contributed up to 5% of your income, they would match another 5% into, so it's basically you're getting a free 5% raise every year. If you use that money and you didn't contribute to your retirement plan, for example, with the University of Michigan, because you're using those funds to pay for student loan payments, you didn't get the match. So that money was foregone by you and you're leaving that automatic raise on the table. Well, now with this provision from the Secure Act, if you're using those funds paying for student loans, you can still receive the match from your employer, so you're not foregoing that income. They've also made it so that graduate and postdoc students are eligible for IRA contributions because, as some of my graduate student and postdoc clients will tell you, they don't really make an income because they're receiving their postdoc or PhD for free, working for the university as research assistants, and they're not receiving an income. They receive a stipend, a living stipend, but they have to use those funds for rent and living, so they don't really have extra funds to contribute to their own retirement account. But now the IRS is going to take into consideration the amounts that they're receiving for those amounts and allow them to contribute also to an IRA, where before they were not considering that as earned income, and you can only contribute earned income to your individual retirement account. Also, because of the Secure Act, they are going to require that a lifetime income estimate is included in all 401k statements. So even if you're not using the annuity that we talked about, your statement will show that based on certain assumptions, based on the amount you have in your 401k plan, based on our assumptions, this money we are estimating would last you this long until you die, or for this many years. Key number 3 of the Secure Act was that it provides new ways to use your money. One of the biggest changes is to something called a QCD, or Qualified Charitable Distribution. One change is that they've now indexed this for inflation. For many years, the maximum that someone could do on a QCD is $100,000. And they've now made that indexed for inflation. So now it's $105,000 in 2024. What is a qualified charitable distribution? It is a donation to a qualified charity from your IRA that also qualifies for your required minimum distribution. So before this, if you gave a qualified distribution to charity, you had to take it out of your IRA first, pay tax on it, and then give it to the charity. And that amount that went to the charity did not count towards your required minimum distribution. But now the funds can be directly transferred from your IRA to the charity and also qualify to take care of your required minimum distribution. So you don't have to take out an additional amount to cover your required minimum distribution for that year. However, please note that a qualified charitable distribution must be done before taking your required minimum distribution to qualify for the RMD requirement. We can also now use our college saving plan 529 accounts to pay off student loans. Prior to this, if you didn't use all the funds in your 529, you either had to transfer it to someone else or take the money out and pay a penalty because it wasn't going to qualified educational expenses. But now you can use those funds up to $10,000 to pay for student loans and not be penalized on that money coming out. And they've also given us the ability to transfer 529 balances to a Roth IRA in the name of the beneficiary of that 529 plan, which are usually children. You can now roll over up to $35,000 from a 529 plan into a beneficiary's IRA. The 529 plan must have been in effect for 15 years and subject to both a $35,000 lifetime cap and an annual IRA contribution limits, which are currently $7,000. In addition, they've added a provision so that you can take penalty-free withdrawals from your IRA or your retirement plans to pay for $2,500 worth of long-term care insurance. This isn't effective until December 29th of 2025. The withdrawal is allowed up to the lesser of 10% of your vested balance in the plan, or $2,500 annually, which will be adjusted for inflation. And this only applies to people who are under age 59 and a half, where a penalty would apply if you took money out of your retirement savings. But if you're taking it out to pay for long-term care insurance up to $2,500, starting in 2025, you will not be penalized. They've also instituted a penalty-free withdrawal for parents of new children, either natural or adopted, of up to $5,000 of the expense of the child for a qualified birth without the 10% early withdrawal penalty. So this is good for younger people who are having children and want to use some of their retirement funds to help offset the expenses of those children. Withdrawals must occur within 1 year of the birth or adoption, and you may still owe taxes on the money withdrawn. So check with your tax advisor. They've also added a few other circumstances where you can withdraw funds from your retirement accounts without the 10% penalty if you're under the age of 59 and a half. And those include people who are terminally ill, victims of domestic abuse, and public safety workers, which now include firefighters as well. All right. The last key that we summarized from our analysis of the Secure Act legislation is dealing with this thing we're calling the death of the stretch IRA, which basically says that your kids or your younger beneficiaries, someone other than your spouse, can still inherit your IRA, but they can only defer the taxes for up to 10 years. Prior to this, you wanted to have younger beneficiaries other than your spouse for your IRA so that they could spread the required distributions over their lifetimes, which for a younger person would be over a longer time period. Now, with certain exceptions, non-spouse beneficiaries of IRAs must withdraw those funds within 10 years. So they can take it all in year 1, they can take it all in year 10, but the account value has to be 0 10 years after the date that of death when they inherited those accounts. So this is going to increase the tax liability if it is a traditional IRA for many beneficiaries of IRAs. there are several exceptions to the 10-year rule, including, as we discussed, surviving spouses. That doesn't include surviving spouses. They can take the money using their, as we've already discussed, younger spouse who predeceased them using their required minimum distribution schedule. Doesn't include disabled or chronically ill beneficiaries. Beneficiaries not more than 10 years younger than the original owner. And minor children. However, if your child is a minor and they inherit your IRA, they will have to distribute those funds within 10 years, starting the year that they reach age of majority, which, for example, here in the state of Michigan is age 18. And this rule only applies to accounts inherited in 2020 or later. So if you inherited already an IRA previous to 2020, the old rules still apply. So the lessons here with regard to the death of the stretch IRA is that you want to consider some planning options, such as converting to Roth IRAs, which don't require taxes when you take the funds out, but they are still subject to the 10-year rule. They just wouldn't have to pay tax on those funds taking the money out. Where in a traditional, as we discussed, they're going to have to pay tax on the amount they take out every year. Develop a distribution plan for your retirement accounts. Manage your tax brackets. So manage how much tax you're paying when, and work on your estate plans. Make sure, very important, we see this all the time with new clients that come to us. They either have no beneficiaries or their beneficiaries are not correct. They've been divorced, their spouse has died, they haven't updated their beneficiaries. So it's very important. If you do nothing else as a result of this presentation, please make sure that your beneficiaries are who you want them to be. If you have a trust, if you want it to be your trust, make sure it's your trust. A lot of people spend a lot of money creating trusts and they never make it their beneficiary. So it's basically worthless. And you want to make sure that your beneficiaries are up to date and who you want them to be. So, in summary, we've covered the 4 key areas of the Secure Act, in addition to the differences between traditional and Roth IRAs. And those keys were that the Secure Act gave us more time to save for retirement with the modification to the required minimum distribution rules. Key number 2, more ways to save for retirement through the various different Roth options and small 401k options and annuity options. New ways to use your money, such as the 529 plans to pay for student loans or roll into a Roth IRA, and that the death of the stretch IRA means that your children still can inherit your IRA, but they can only defer taxes for up to 10 years if it's a traditional IRA. As I mentioned, if you'd like me to email you the summary guide PDF based on this presentation, I'd be happy to do that. Just shoot me your email me. I'll give you the contact information at the end of the presentation, which is right here. I appreciate you taking the time to sit through this. I hope you learned something. If there's anything related to this or unrelated to this that my firm or I can do for you, we don't charge for consultation meetings. So we'll sit down with you and tell you exactly what we think and what we can or cannot do for you. Answer any questions you have. Please don't hesitate to give me a call, shoot me an email. I wish you all the best, all the safety and health in the world, and hope you and your family are safe and live a healthy and wealthy life. Thanks and take care.